And I'd like to go ahead and welcome everyone to our April webinar, Foreign Exchange Risk for Small Business Banks, a case study on XacBank, presented by Julie Abrams and Amar Hanibal. My name is Jessica Alfaro, and I'm a manager at CapPlus Exchange. And I'd like to thank everyone for joining us today. Julie Abrams is founder and managing director of Impact Investing Analytics, an independent consulting firm specializing in access to capital, innovative solutions, and proof of concept for investing, impact investing, social enterprise, SME, microfinance, and financial inclusion in domestic, emerging, and frontier markets. Her work focuses on all phases of the investment life cycle: risk management, corporate governance, financial and social performance, strategy, and training. Julie has been involved in over 250 million in impact investing transactions in over 35 countries. She is a subject matter expert in foreign exchange risk management, corporate governance, strategy, financial and social performance, due diligence, and all phases of investment transactions, including extensive investment committee experience. Julie was a fellow at the Lauder Institute of Management and International Studies, where she earned an MBA from the Wharton School and an MA from the University of Pennsylvania. She also holds a BA from Oberlin College. Mr. Amar Hanibal joined XacBank in July 2014 as the president. Prior to joining XacBank, Amar worked for 3 years as the managing director for Tangier Financial Group. Previously, he was the managing director, head of risk management at JSC CazCommerceBank, KKB, the largest commercial bank in Kazakhstan. Amar joined KKB in 2008 with over 10 years of experience in international banking, specifically in risk management, project finance, and leveraged finance. Prior to joining KKB, he held positions with ABN AMRO Bank in various global offices, including London, Amsterdam, and Chicago. Amar earned a Bachelor of Business degree from the European University of Brussels in Belgium and an MBA from Harvard Business School in Boston, USA. Next slide. If you have any technical problems during the webinar, please do contact my colleague David Sheffick at the email address or via Skype. We do encourage you to participate fully throughout the webinar, and we'll be taking questions continuously via the chat box on the right-hand side of the screen or through the questions box. At the end of the session, we'll have a discussion period, and you can either ask your question directly or I'll read them aloud to the facilitators to respond to. This video and all of our completed webinars can be seen online on our web community at this web address. We do have other upcoming webinars as part of our ongoing series, and you can access and register for these webinars online. So in May, we have a session with the SME Finance Forum on financing women-owned enterprises, and July 20th, a session on Bitcoin and blockchain coming up. So please do view those and register for those online. We do ask that you send out this webinar calendar to any of those who would benefit at your institution as well. And at this point in time, I would like to turn it over to our very experienced facilitator, Julie, to lead us in this webinar today.
Great, thank you, Jessica. So I'm trying to advance the screen, and do I have control of the screen here?
Yes, you do.
Okay, it's not, when I'm pressing advance, it's not advancing. Not sure. Do you know why that might be? Sorry about that. It was working fine before I was sharing screen, so let's see. If I shrink my screen, sorry about that.
Maybe go back out of slideshow mode for a moment and just see if we can figure out how to advance it from there.
Sure. Sorry about this, folks. Yeah, I'm not getting my escape. Hold on. Okay, let's see. There we go. Sorry about that. Okay, great. So do you want to comment on this slide, Jessica, briefly?
And this was our slide on the technical problems. If you have any technical problems, you can contact David. The next slide. And this is our list of upcoming webinars. And we'll turn it over to you, Julie.
Great, thanks so much. Thank you, Jessica. I'm honored and delighted to be here at this webinar with Amar Hanibal, President of XacBank. Many of you may know that XacBank has long had a reputation as a leader among microfinance banks and now SME banks. And hearing this case, I think you'll see one aspect of how they have gained such a great reputation. Today we're going to discuss foreign exchange, or FX, risk for a small business bank. I'm going to first give a brief overview of FX risk, including its definition, how it is measured, and why it is important. We'll then turn to the focus of the webinar, which is FX risk challenges that XacBank faced and how it approached these with a very innovative solution that was in its clients' best interests as well as the bank's bottom line. We will conclude with some lessons learned, some key takeaways and parting words, and then take your questions. So you may pose questions in the chat box throughout the presentation, and then those will be addressed and answered during the question and answer session. So let's first just make sure we all know and what we're talking about here, foreign exchange risk. And this definition is the possibility of financial loss to the bank or institution arising from adverse movements in foreign exchange rates. In today's case, we're going to actually look specifically about how adverse movements in the Mongolian currency, which is the tugrug, specifically quite a very rapid depreciation or weakening of the tugrug against the US dollar, led to a number of challenges for XacBank and how it handled this situation. And the reason we're presenting this case is because it's really quite relevant for other SME banks, also microfinance banks, operating in markets that have volatile and often depreciating currency. We're assuming you have some familiarity with risk management, and just to situate foreign exchange risk, as we know, institutions face credit risk, operational risk, and market risk. And foreign exchange risk is a market risk due to the impact that the currency markets can have on it. Interest rate risk is another form of market risk, but we won't be addressing that in this webinar. And what's particularly noteworthy is that foreign exchange risk can actually result in credit risk, which is what happened at XacBank. Specifically, that's because the depreciation of the local currency, as we mentioned, the tugrug, made it more expensive and harder for their customers to pay back those US dollar loans, and that led to an increase in the non-performing loans in their portfolio, and also XacBank's need to increase its loan provisioning. So I think that's quite interesting how something that's market risk really converts to credit risk. Then in some instances, what can also occur is called currency-induced credit risk, CICR, and that occurs when local bank clients take on unhedged foreign currency debt, in this case the US dollar, that they have to service and repay. However, they're earning in their small business only local currency revenues. And this makes these customers quite vulnerable to depreciation or devaluation of their local currency as compared to the currency in which the loan was issued. And most SME clients would fall into this category. Now, larger corporate clients that have exports or imports or more sophisticated treasury function might be better able to handle and manage this FX risk. And yet, even clients that are earning revenues in US dollars, they may also find that the time lags between the invoice and receipt of the payments from their own clients also leads to this currency-induced credit risk. We're also now going to talk about how you measure FX risk, and the basic measurement is called the net open position, in which each currency is operated in. And this slide just really shows a simplified version. This is 2013. It's actually XacBank's own balance sheet. So the way that you measure the net open position is that first you divide up your balance sheet sliced by currency vertically. So you see in that column the MNT, that's the tugrug, the local currency of Mongolia, and then next to that is the US dollar, and then the second column. XacBank also has a small amount of euros and also the Chinese yuan. For this case, we're really going to leave it simple and just focus on the US dollar, which is what most of their foreign loans are in. And these are, as I mentioned, actual figures. So we've really simplified this balance sheet, and the light blue lines show the dollar, the main sources of dollars here. So in the liability side, we have borrowed funds, and these are loans that XacBank got from cross-border lenders lending to their institution. And on the asset side above, you see the loans to customers. These are the loans that XacBank issued to its own clients in US dollars. And the way you calculate the net open position is you subtract the total assets, that's the yellow line 1, minus line 2, total liabilities, and you get the net open position, which is assets minus liabilities. You do that for each column or each currency. Then you divide that by total equity, which we have as row 3, and that calculation is the net open position as a percent of equity. Now in some cases the regulator may set a limit on how much for a single currency can be held. So for example, the Bank of Mongolia, which is Mongolia's central bank, sets a limit of a 15% limit on exposure to a single foreign currency. So therefore, as you can see, XacBank was only at 5%, so it was well within the prudential limits. The Bank of Mongolia also has a limit of 40% total foreign currency exposure, which XacBank was also well under. But what we'll find in this case is that the prudential limit, even if you're within that, may not be the only thing you might need to be concerned about. Another thing that occurs is often a hard currency lender to an SME bank, such as an investor, will also have a foreign currency covenant in their loan agreement, and that will also limit this exposure. So in that kind of situation, the bank, such as XacBank, also has to comply with that covenant, and that also may unintentionally lead a bank such as XacBank to lend to its customers in US dollars. Quick terminology: if the bank has more liabilities than assets in a given currency, such as the US dollar, then we say they are short in that currency. If they have more assets than liabilities, we say they are long in that currency. From a risk perspective, SME banks are typically more concerned with short positions in foreign currency because this leads them to be vulnerable to depreciation of that currency. Now, as you can see in this slide, XacBank has more liabilities, that's the 535 trillion in yellow, than their assets, the 530 trillion. So in this case, it is short in US dollars. So we're going to now talk about ways to hedge that foreign exchange exposure. So here we're going to briefly talk about hedging techniques for foreign exchange risk. And just to note, a deeper dive into this quite important subject is beyond the scope of this webinar, but it's very important. The green highlights the main types of hedging that XacBank used. So you see they use what's called a natural hedge and also cross-currency swaps. So a natural hedge basically matches the foreign currency, in this case the US dollars on the balance sheet that were generated by borrowing hard currency from foreign lenders, and matches them with the corresponding volume of assets, and that's typically to their customers. Now I would point out natural does not necessarily mean good. It simply means it is done without other products such as derivatives or non-derivatives. One thing that I think seems appealing about a natural hedge is that there doesn't, so for example, the non-derivatives, there's attached to those, or a price or an increase a certain number of basis points that are at edge. A natural hedge, because you're doing it on your own balance sheet, doesn't seem to incur a direct charge. However, as you'll hear in this case, there's actually quite a large charge of various ways. One thing I want to point out about hedging and SME banks. So the core business of an SME bank is, and the business focus is their loan book, and that they can incur foreign exchange risk on their balance sheet through cross-border borrowing, but they really they really should be focused on their loan book. So a larger traditional or corporate bank may, in contrast, may take proprietary speculative currency positions and manage that on its own account, and that's really beyond what should be the focus of an SME bank. So really there is a need to hedge the risk if you're an SME bank. Amar, did you want to add any further comments on this slide?
No, that's fine.
Great. So now we're going to actually delve into our case, and Amar is going to introduce briefly XacBank.
Thank you, Julie. Just briefly, XacBank is one of the top 4 commercial banks in Mongolia. Actually, our origins lie in microfinance dating back to 1998 when a microfinance initiative was funded by UNDP. Gradually, we became a non-bank financial institution and eventually in 2001 obtained our full banking license. Since then, we expanded our business to include full scope of retail, SME banking, leasing, insurance, treasury and corporate finance, as well as brokerage services. Today, we are equally divided between SME and retail business segments in our commercial banking operations. What distinguishes XacBank from our competition is its the balanced shareholding structure of the bank. Our shareholders include such institutions as IFC, EBRD, National Bank of Canada, Forex, and others. Some of these investors are also our funders. We have a long-standing relationship with a multitude of international finance institutions, DFIs, and specialty SME and microfinance institutions. These funding partners provide us with significant amount of loans to finance our operations, and the majority of such loans are denominated in US dollars. Next slide.
Great. Sure. Now, Mark, can you tell us briefly about the origin, about how and why XacBank has FX risk exposure, please?
Right. So if you will look at our liability structure, we have a almost balanced mix of local deposits and foreign borrowings. The characteristic of local deposits is such that they tend to be shorter tenor and more volatile, and they're obviously denominated in local currency. On the other hand, the foreign lenders provide us with stable, longer-term funding, usually tenors of 3 to 5 years, and at significantly low cost, given the nature of these funders. So therefore we seek foreign funds given the fact that Mongolia has a relatively low deposit base, but on the other hand the banking assets are growing very fast. If you were to look at average annual growth rate over the past several years, it's been over 30%. So in order for us to fund this growth, we basically have to rely on foreign funding. So as a result, roughly 40% of our liabilities are foreign currency borrowings.
Great. Thank you, Amar. And one thing I do want to point out here is that we're specifically focusing on foreign currency debt. As Amar noted, it's on the liability side of the balance sheet. And we're not focusing on equity. By definition, equity would be in local currency, and any FX risk would really be borne by the equity investor at the time of their exit. So as Amar mentioned, they have a number of foreign equity investors as well, such as IFC, EBRD, Oryx, etc. And this is really focused on the debt component, not equity. So I just wanted to clarify that. So Amar, can you explain to us how and why you used a natural hedge at XacBank, and also how did your experience, you had mentioned when you and I spoke that the experience in the 2008-2009 financial crisis in some way influenced your actions in 2013 onwards. Can you tell us a bit about that, please?
Sure. So basically we tend to match our foreign currency book through a natural hedge simply because what I mean by natural hedge here is, as you explained earlier, is funding our US dollar loans with US dollar borrowings. And the reason why we prefer natural hedges is because there's not a lot of options for us to hedge. Then the local market does not have a depth of derivative contracts that we could use to hedge the FX risk. We occasionally are able to do some cross-currency swap, but short-term with local banks. And so, as you mentioned, in 2008 and 2009, a major rethink of our FX risk management was triggered by a relatively short-lived but nevertheless important financial crisis that happened in Mongolia. During this crisis, the Mongolian currency tugrik depreciated quickly. As you can see, going from 11,144 to 15,124, in a matter of half a year, and therefore even less. So therefore, this FX volatility translated into a credit risk for some of our clients, especially those who took out US dollar loans. This translation of FX to credit risk really happened as a result of ever-increasing debt service charges when the monthly dollar loan payments were translated into local currency. The cumulative increase, depreciation of the currency was quite significant in 2008 and 9, but as I will explain later, the current crisis has a much deeper impact. If you were to look at the chart that shows the absolute numbers of exchange rate, the currency depreciated quickly, but it corrected itself equally in a short period of time. This scenario repeated itself at the end of 2013, but this time the crisis has been prolonged. It's still continuing. Today the exchange rate is a little below 2,000.
Right, and so as you can see, I'm sorry, go ahead please.
No, go ahead.
Well, I was just going to say, so the chart, just to make sure to convey the chart in terms of what Amar is saying, so the blue circle on the left was when there was a spike or a depreciation of the currency in 2009, and what Amar is referring to 2013 on is that blue circle on the right, whereas you see it also had a steep increase. However, instead of going down, like you see on the left side of the chart, as Amar mentioned, it's continuing to go up and still is doing so. Go ahead, Amar.
Yeah, so the cumulative depreciation of the currency has been close to 43% since 2008. And this was a much deeper crisis for us simply because the economy is much bigger, the banks are larger, the customers are more leveraged. So therefore, the level of US dollar exposure is significantly higher now than compared to 2008 and 9. So during this beginning of late 2013, during the beginning of this crisis, we started to talk, engage our clients and talk to them about potential risks of depreciating currency. We also engaged central bank because I think the role of the regulator is very important in these situations. And not just us, but the other commercial banks also engaged the central bank. As a result, Central Bank of Mongolia took some countermeasures, and one of the most important ones has been the cross-currency swap that was made available to larger commercial banks such as XacBank. What it allowed us to do is basically to swap our US dollar borrowings into local currency, thus reducing the pressure to revert to natural hedges. Also, the central bank increased the provisioning requirements for dollar loans. So
Great.
As the currency slid, we became concerned with the impact on our profitability and our credit risk. Given the fact that currencies of commodity-driven economies such as Mongolia was across the world, we felt that this was going to be a somewhat different crisis than our previous experience. So using some of our data that was available to us from 2008 and 9, we sought to calculate the potential impact of currency devaluation on our asset quality. So we estimated that if the US dollar loan was left untouched, then our projected credit costs would have increased by almost 90 basis points. Now, NPL ratio would have increased substantially further. And this would have been on top of already high credit loss as a result of general economic downturn. So we ran several scenarios with our customers. Basically, we concentrated on FX losses, non-performing loans, and as a result, the provisioning levels. And so we ran several scenarios that compared foreign exchange losses with additional credit costs. And we came to the realization that if we didn't do anything, and let the dollar loan book to run off or continue to be at the same level, that we would have incurred maybe 4 times higher credit costs than the FX losses. And obviously these calculations were guesstimates because there are so many other factors that affect credit risk, not just FX volatility.
Right, and Amar, when you had mentioned that there was a gut feeling about what was going on, can you explain for other people who are in SME banks, when you have this gut feeling, how do you back that up and link that to your forecasts and models?
So our gut feeling was basically that this crisis will be a repetition of 2009 crisis, and hence we wanted to visualize what the impact would be on the asset quality. And we ran some of the statistics from the previous crisis, statistics related to default rates, loss given defaults, and recovery rates and provisioning levels, and extrapolated to our then existing back in 2013 loan book, and wanted to basically see what would be the impact on a bank's profitability 1 year or 2 years down the road.
Thank you. And you also mentioned, though, besides being concerned, there was a sense of urgency. And you had mentioned to me that you didn't feel you could sit idly. Can you talk about that, and also the role of who was involved in making decisions and how that worked?
Mm-hmm. So in 2013, our corporate and SME loan book was nearly half of our gross loan book. So this proportion was very small back in 2008. So immediately we felt that the impact would be much greater. Also, our balance sheet was bigger and more complex. So there's a real sense of urgency based on our past experience that we had to act very quickly. So together with our risk management department, our finance unit quickly ran the numbers and presented to risk management committee, which was then escalated to our executive bank committee. The executive bank committee consists of our CEO, myself, our 5 VPs, and we discussed this issue in a very urgent manner. We then delegated our asset liability committee to run several scenarios and come up with recommendations as to how to reduce our FX exposure and how to reduce the potential increase in credit losses. We also worked with our commercial units to educate them on how to handle our existing clients who have US dollar loans, and what to advise to them. We obviously worked very closely as a senior management with our board, so our board risk management committee, to inform them of our existing US dollar exposure on both asset side and liability side, and the impact of further depreciation.
And Amar, in terms of the board, would you say this was more of a strategic board decision or really an operational decision among your executive bank senior management?
This was more operational matter. I think the board basically delegated the authority to management to manage it. Obviously, they were concerned and they wanted to be kept abreast with the developments, but generally speaking, the overall directive from the board was to aggressively reduce our exposure to dollar loans.
Great. And so, Amar, so once your executive decision had been made that you needed to convert some of these US dollar loans to TUGRUB, how did you decide how that would be handled and who would take the hit or the loss on doing so? Can you describe that a bit to us, please?
Yeah, so internally we discussed converting the loans at then prevailing exchange rates, but obviously that proposition was not very attractive from a customer point of view. So we ran several scenarios where we split the so-called split the difference. In other words, if there's a 200 MNT difference between prevailing exchange rate and at the exchange rate they want to convert the loans at, who would take how much of the difference? So we looked at 80-20, 60-40, 50-50 sharing. and eventually, I think in most cases, we agreed with our customers on 50-50 sharing of the FX losses. Obviously, from a clients were very reluctant initially to convert because everybody, as we all know, everybody has their opinion in exchange rate, and nobody believed that the exchange rate depreciation was long-lasting. People were pretty sure that things will go back to normal, but as the time went past, customers became more and more concerned, and it became easier for us to convince them. We also developed an Excel sheet that helped our customers to understand the impact of falling Tugrik exchange rate on their monthly debt service charges, and how the interest rate differential was basically wiped out at a certain level. So this was, some clients were more sophisticated and others understood very quickly, others took more time to explain. Eventually, most of the clients understood the risk because the exchange rate became increasingly volatile. So basically what we directed our relationship managers is to explain to our customers who have taken out dollar loans how the exchange rate impacted their profitability and in certain cases viability, and try to convince them to convert the existing loans to US dollar loans to local currency. We also revised our credit policy by heavily restricting any new US dollar loans. Essentially, we would allow our front office people to sell dollar loans only if the customer could show dollar revenues or index dollar revenues or some other ability to absorb FX fluctuations. So now we also severely restricted dollar lending in our retail banking unit. So now we have predominantly dollar loans. And one other thing that needs to be mentioned is what allowed us to, as you can see from the slide, to drop our dollar loans from 37% to 15%, now it's even lower, is the fact that we had access to central bank swap facility. Without it, I think it would have been very difficult for us to match the book. Because we had the ability to swap dollar borrowings into local currency with central bank, this allowed us to be more flexible on the asset side.
Great, thank you, Amar. And just to explain this graph, so the blue is the proportion of the XacBank's portfolio to its customers that remained in US dollars. So as you can see, back in 2008, it's before the financial crisis, it was 40% of the loan book was in US dollars to their clients. And it dropped a bit, but then in 2013, it again rose to 37%. And the measures that Amar was speaking of in terms of converting and doing this split the difference 50-50 conversion into local currency led to the shrinking or a smaller blue area of the loan portfolio being in US dollars, to the point where at the end of 2015 that was only 15%. So as you can see, that's the lowest percent since 2008. And as Amar just mentioned, it's a bit even lower now. So this was a pretty dramatic shift in the composition of the balance sheet of XacBank here, as you can see.
One thing I want to mention here is that besides just converting the loans from dollars to local currency, we also, for certain more sophisticated and larger clients, offered a US dollar loan, but with a local currency put. In other words, we would agree with the client and for an exchange rate level, and if that exchange rate level was reached, the existing loan would automatically convert into local currency with pre-agreed interest rate and tenor. This allowed basically us and for the customer to cap the potential FX losses should the exchange rate become even more erratic and volatile. obviously not all customers are able to grasp the sort of the mechanics of it, but some customers do understand it and appreciate this feature.
Right. Now, Amar, so I know you're the president of XacBank, but imagine if you were one of these, the relationship managers, and I was one of your clients, what would you say was my biggest hesitation and what was hardest for me to be willing to go and take this 50-50 split the difference approach? Can you just give us a bit of flavor what that was like really on the front lines between your credit staff and the clients?
Well, as I said, I think the clients were reluctant to believe, let's say they were in denial that the exchange rate would continue to stay at this high level, that at some point it would go down and things will go back to normal. And the other feature that sort of worked somewhat against us is that in the local market, the dollar loan interest rates are significantly lower than the local currency loans. Dollar interest rates, we're talking 500, 600 basis point difference in interest rate. So for them, basically, it was difficult to accept the fact that exchange rates would not come down very quickly, and also to realize some of these FX losses immediately. So we had to work quite a bit with our customers to convince them that this was a necessity. In certain cases where client already missed some payments, it was obviously much easier to convince them than the clients who are generally current on the debt service.
Sure, great. No, thank you, Amar. Now I'd like to turn to lessons learned, and stepping back a bit from this, Amar, and your experience, can you tell us what you feel are some of the most important lessons you felt were learned from XacBank's experience with FX risk?
Mm-hmm. So basically, for banks that operate in an environment like we are in Mongolia, we have to basically raise hard currency loans from outside in order to fund our operations. And very often there's a big mismatch between how much you can raise on foreign market and how much you can lend domestically. So there's always a dilemma how to manage this mismatch. In this particular case, what we realized that it was better for us to accept an FX loss now than risk potentially much higher credit costs and deteriorating asset quality. And the second key point was that around this time we also changed our strategy, revised our strategy, and instead of sort of shooting to become one of the largest banks, we were concentrating on becoming more efficient and profitable. So for us, customer viability was the key. Long-term viability of our customer was the key success factor to our profitability. Therefore, we became more conscious of responsible lending practices, and we were willing to take some of the losses and basically split it with our customers in order to support them, but also help ourselves.
Sure. And I know also that the FX losses and the resulting somewhat higher non-performing loans and provisioning can in general have an effect on earnings. And in fact, there was some portion of the net income that was lowered due to FX losses. And in some case, in prior years, sometimes there were FX gains. The point being that FX, the key operating word is risk, so that you can lose money and gain money on it, but it's really a risk that you want to try to control.
Mm-hmm. Exactly. One other thing I want to add on this one was we had to, given the fact that we don't have the ready availability of all the derivative instruments, you have to be a little bit innovative with how to manage your FX risk. You either build it into a product, or you have to rely on a relationship with your clients, and obviously work with your regulator to manage this risk, because I think without regulators' help, I think this would have been very difficult. and therefore, I mean, the bottom line is there is no easy answer to how to manage this.
Right, and I think it's great that the Central Bank of Mongolia was able to provide cross-currency swaps. And so I would say that for other SME banks in their country, in terms of when looking for different FX risk hedging alternatives, obviously you want to check if the central bank provides something such as done in Mongolia. So Amar, stepping back, what do you feel are some of the key takeaways? We have SME senior managers on the line handling and thinking about these same issues in their own bank. So what would you say, what advice would you give them from this experience?
Well, I wouldn't say it's advice, but more of a conclusion for ourselves is that in a fast-growing economy like Mongolia, it's very tempting to try to grow as fast as you can to, you know, become the first, second, or third largest bank. But what we realized and what we now pursue is that quality of earning is what matters most. I worked in Kazakhstan previously, and there the growth was equally rapid, but the quality of earnings disappeared very quickly, and that had a major impact on the viability of commercial banks in that country. So quality of earnings is more important, and that's the thing that keeps good banks afloat. So therefore, we believe in long-term viability of our customers being the major factor to ensure our profitability. Therefore, just because we raise a lot of dollar funds abroad is not an excuse for us to push dollar loans to our customers. Therefore, unless we are able to manage our FX risk on our balance sheet, we would rather not raise the foreign borrowings as much as we used to. So from this experience, based on this experience, and we have reformulated our 5-year strategy, and we want to be most reliable and profitable bank in Mongolia going forward. And it also forced us to become more proactive, as there is no crystal ball that really tells you what would happen. You often have to rely on your gut feeling, and I think the consensus that was built within the management team to decide on the course of action was very important. Had we not agreed and there was a lot of conflict and disagreements, I think we would have lost valuable time in dealing with this issue. So this consensus-based decision-making played a major role.
Great. Thank you, Amar. And so couple things I'm really struck by from what you've told us. One is that XacBank's approach was very pro-client, and I know that XacBank in last year received Smart Campaign certification, which is showing successful implementation of client protection principles implemented into your operations. And I think this is a great example of what responsible finance looks like that's very much benefiting the client, where you split that difference, you're much more aware of offloading FX risk onto a client when they can't necessarily return the earnings in that currency. And there was something inherently fair to me about that 50-50 split the difference, that even though it was obviously going to hurt XacBank financially and the client, it shows sort of a shared alignment of working together. So I really thought that was interesting. And then also I appreciated how you explained that deciding to take FX losses intentionally in that way, in that 50-50 split the difference, actually optimized your bottom line, because as you had mentioned, you would have actually had greater losses in terms of that market risk gone to turn into credit risk and the higher provisioning, higher non-performing loans, etc. So I think this seemed like a really smart and savvy strategy. What I think is also quite interesting, you mentioned this new 5-year strategy, rather than focusing primarily on growth, to focus on profitability and quality of earnings. And in fact, I was looking at the 2015 XacBank results, and indeed the portfolio, your loan portfolio, actually shrunk by nearly 10%, 9.6%. Which is not the most traditional strategy to shrink a portfolio, and yet XacBank's return on equity increased from 9% to nearly 16%. So I just want to highlight this strategy is actually already being implemented and is already succeeding, which I think is fantastic. Excuse me. So, hold on. Why is this not advancing? Okay. Why am I not advancing, Jessica?
So if you click on the screen, if you click back on the PowerPoint and then hit your down arrow, you should be able to.
Got it. Yes, got it. Great. So one thing I noticed also, this is from the just this very recent 2015 annual report from XacBank, and they do acknowledge that the past year has been a challenging one for many companies in Mongolia, particularly given that depreciating currency that we saw in those graphs. And what they say is that we are working together with our clients to overcome these challenges, and we believe this collaboration would strengthen our relationship with clients. And I think what you've heard from Amar really underscores these aren't just words on a page. This is really what XacBank is doing, you know, on the streets with its clients, in its offices, and it's really walking the walk. And I think that's quite impressive. So Amar, did you have anything else before we go on to questions and answers?
No, well, I don't have anything else.
Great. So I'm going to pass this over now to Jessica in case we have any questions from our audience. Thanks.
Great. Well, Amar and Julie, thank you so much for this very interesting information. And we are starting to get in a few questions, and so I'd like to encourage folks, please go ahead and post your questions in the chat box or the question box. And if you'd like to ask your question directly, I can go ahead and unmute your microphone. And so we do have a question from Dean. And Dean, if you want to tell us where you're joining from and the organization that you're representing, and your questions for Amar and for Julie.
Yeah, sure. Amar, Julie, thanks so much. This is really interesting. I work for a company called Convergence. We're a new startup, and we're helping to connect public investors with private investors for kind of blended finance transactions in emerging markets. So I got two questions. So the first question is, I know there's quite a few currency hedging facilities and solutions out there, like TSX and MFX. I know MFX is specifically for microfinance institutions. Just wanted to know if those were around when you went through this process, and if they were considered, and if they were considered, why you didn't decide to kind of use one of their hedging solutions, or if there wasn't a hedging solution offered. That's my first question. And then my second question is, how many kind of clients did the bank have that had these US dollar loans? And what was the, I guess, average negotiation process average time for the negotiation process to convert those loans to the local currency? It seems like if there's a lot of clients, that could be a pretty intensive process, and would love to know the process for that and how you found staff capacity to do that.
So, Dean, thank you so much for those questions. I just want to mention something brief, and then I want to turn it over to Amar, who can answer almost all of this. Just in terms of, you mentioned TCX, which is indeed a large hedging facility that mostly development finance institutions have access to. It's really for larger institutions to access. MFX Solutions did originally start out solely for microfinance, but indeed it does provide hedging services for other types of institutions, including SME, including solar. So I think the same kind of capacity that MFX Solutions, it's mfxsolutions.com, provides has been providing for the microfinance industry, actually has translated quite well to other sectors. So I want to pass it on to Amar to answer the rest.
So thank you for the question. As far as the TCX and MFX are concerned, we obviously aware of availability of these two platforms, but for us, even now and back then, both of these platforms were too expensive, and the reason why is Mongolian tughlik is not one of the major or even secondary currencies, and up until recently, we really didn't have a sovereign bond curve, yield curve. It was difficult to price long-term swaps. Since then, back in 2012 and 13, the government did issue international bonds, which allowed the central bank to extrapolate a yield curve, and then they were able to provide us with much more cost-effective swap opportunities than TCX and MFX. So that's one of the reasons why we weren't very keen on using TCX and MFX. As far as the number of clients, I think we're talking majority, mostly about SMEs, so the numbers are within limits of about 100 or so, including some retail clients. So as some of the loans ran off or they were about to expire or to be up for renewal, we basically instructed our relationship managers to talk to them. On some of the more vulnerable clients, we more aggressively approached those clients. So it did take some time. I think the conversion started to the end of 2013 and initiated end of 2013 and it continued well into end of 2015. So it wasn't a quick process. It's not like a trader flips its assets very quickly. It took quite a bit of time and effort to do this.
And I'd just like to also conclude, Dean mentioned he's from Convergence. It's actually a very exciting new initiative, and I would encourage folks on the call to take a look after this webinar. It's convergence.finance is the website. It's quite an interesting new organization. Thanks.
Excellent. Well, thank you very much, Dean, for that question. We had another question going back a bit into the beginning of the case study where we were talking about when you were converting your portfolio to the local currency, to MNT, did this cause a currency mismatch with your liabilities? And if this was the case, how were you able to pay back the DFIs and the international funders? This is for Amar.
So we basically, yes, there was obviously a mismatch. Where we, as I mentioned during the presentation, we had access to central bank swap window, so which allowed us to swap MNT dollar loans into local currency, and so basically as the swap ran out, the central bank gave us dollars back, we gave them Tugrik back, and we were able to repay our DFIs and other lenders. In certain periods we had short-term mismatches that we had to take care of through short-term swaps, either with central bank or with our peer banks in the local market. So indeed, if there wasn't a swap opportunity, it would be very difficult for us to do it in such a short period of time. It would have taken us much longer to do this exercise.
Great, thank you. We had another question coming in from Deepak. Deepak, I've unmuted your microphone. Are you able to ask your question directly to Amar? Deepak, are you there? Okay. Hi, Deepak. Thank you so much. It looks like I'll go ahead and ask that question. So Deepak was asking whether or not XacBank anticipates currency-induced liquidity risk, and if so, how would you have handled this risk as well?
Mm-hmm. So, back in 2008 and 9 crisis, we did have a currency-induced liquidity risk. There was actually a run on banks, and not us, but some smaller banks, as a result of people getting scared from violent, movements in the exchange rate and floating rumors. So what we usually do during this period, during these situations, is that we have a crisis plan where we basically increase availability of dollars through our branches, through our ATMs. We do a lot of PR campaigning and reassuring our customers that the bank has ample liquidity and able to meet any obligations or demands on cash. So we also freely allowed depositors to convert their deposit from local currency to dollars. So basically, yeah, this was a lot of sort of soft work that went into reassuring that the liquidity risk wasn't too much, and we were able to manage it.
Great. Thank you. We are still taking questions, so please feel free to post your questions in the chat box or in the question box, or go ahead and raise your hand and I can unmute you to ask your question directly to the presenters. And we always have questions coming about, you know, how to do something like this, how to make one of the big change, and who are the most important players, you know, who are the team that needs to be involved in taking this idea from the initial stages to the execution. So Amar, maybe you can just, I know we discussed this briefly, you know, the different committees and the role of the board, but just taking us through the different role that you know, the board plays versus the senior management, and then also the role of the credit team. Obviously it was very you know, intensive period of time between 2013 and 2015 that they needed to spend on this. So I think it would just be helpful for the participants to understand a little bit more on the team members that are involved in the different roles that they play.
So the board over is the ultimate sort of governing body within our institution, representing the shareholders and also the independent directors. But the board's involvement lags in time, because our board meets 4 times a year, and they usually look back at what happened with the bank. And so the role of being proactive and managing risks and mitigating risks really comes down to the management team. And in terms of management team, we operate through committees, various levels of committees. So I think 3 of the most important committees are Risk Management Committee, Executive Bank Committee, which is basically a managing board of XacBank, chaired by a CEO, and then we have Asset Liability Committee that deals with specifically issues of market risk, liquidity, FX risk, etc. So, and I myself sit on all 3 committees. As the president, but I also have a dual role of managing the SME and corporate banking unit of the bank. So I have a very clear and direct visibility of what's going on with our SME clients. Hence, this knowledge and being close to the front office helped me to appreciate and grasp the importance of acting very fast. So through our executive bank committee, we decided overall strategy. Outlook committee, together with risk management, provided the necessary calculations and options and instruments.
And Amar, in terms of, since you had those dual roles and that did keep you closer to the frontline staff, in a bank, SME bank structure where it's a bit more hierarchical and you don't have that unit responsibility in addition to your higher role, how would you suggest that SME banks at someone at your level really keep close touch with the front lines and ear to the ground?
Well, I would suggest that I believe that as the institution gets bigger, when it's small, it's easy to operate directly and manage it yourself. But as it gets bigger and more complex, it's better to manage through various levels of committee and make sure that committee discussions are. First of all, the committee memberships are defined very clearly, and they are, everybody who participates contributes and brings value, and also you want to avoid just, spending all of your time sitting in a committee, so listening to reports, but really discuss and very often argue and challenge each other to make these decisions. In my case, in our case, we have 2 main business units. One is retail, other one is SME, and all of these 2 units obviously major revenue and income drivers. Hence, they work very closely with each other, but also with the main units, cross-functional units such as finance, risk management, and treasury, to manage their own respective businesses. So again, we do it through committees, which in our case works so far quite well.
And just very briefly, I know we're running out of time, but would you say in these decisions that you were making among the senior management team, did everyone agree right away? Was there dissent? Was there, you mentioned maybe not arguing a little, can you just give a little flavor what it was like being in that room and trying to make this kind of decision about what led to this 50-50 split the difference?
Yeah, I think there was a lot of resistance to this. Basically, some of the members of the senior management were reluctant to take on FX losses. So yeah, I think it took quite a bit of convincing and arguing among each other to really come up with a general strategy. But yes, it wasn't easy process.
Great, thank you. Well, we are running out of time. I wanted to just ask a very kind of general question, and this goes back to Julie's question about advice that you would give to institutions. One thing I thought was very interesting, Amar, is that you talked about your gut feeling about some of these risks coming up. And so what were some of the red flags that you saw or that an institution should look for which might signal some of the foreign exchange risk issues that Haas went through?
I think obviously there was a structural issues in our loan book, meaning that we had quite a bit of loans in the retail portfolio, which was a big red flag and a no-no. And then in good times it's fine, but when things get a little bit rough, I mean it's the first portfolio that starts to suffer. So I think you have to be very careful with easily lending foreign currency into domestic retail market. A second sort of red flag is basically look at the composition of the SME loan book. I mean, how many of your dollar borrowers are truly big, large, diversified companies? How many of them are families, small enterprises who want monoline business, who are less likely to be able to weather out the FX volatility. And obviously looking at macro developments, the FX foreign exchange gyrations and central bank actions, all of these, I mean there's so much data that one has to absorb and really try to understand it. And as a result of this, we are become big believers in analyzing data. Banks have a lot of data within their organizations. I think we are just starting to learn how to use it. I think it's a very important factor.
Great. Well, thank you so much. I'd like to thank both Amar and Julie for the session today, and thank all of our participants. If you do have any further questions, please do reach out to CapPlus Exchange. We're happy to link you up with either Amar or Julie. And also we will be posting some of our unanswered questions and some of our answers from these questions on our LinkedIn group under CapPlus Exchange. So please do go ahead and join the discussion there as well. So thank you everyone and have a great day.
Thanks, Jessica. It's been a pleasure. Thanks, Amar.
Thank you very much.